I've got friends and associates that think, you go to $200 wouldn't shock them. And they're fundamentally astute folks. I won't mention their names. You probably know them. I fully agree. But right now, I'm just looking at this leg that is beginning to unfold. And I think it's going to blow past that silly high at 50 and the other high back in 1980 at 50,
Yeah.
which is, they're sucker highs. They're ridiculous. In
Yeah.
real dollar terms, we'd have to be probably $200 or 300 just to match those highs.
Conversely, gold has already surpassed its previous highs, peaking at over $3,500 an ounce. For many analysts, this gap creates a catch-up opportunity for silver, which is still undervalued. Seasoned investor MichaelOliver views the current silver move as the beginning of a major rally and predicts silver could climb up to $70 within 5 months. In the long term, he believes inflation-adjusted highs near $200 to $300 are possible. Overall, Oliver expects silver to outperform both gold and gold miners as it makes up for years of underperformance. Based on fundamentals, Oliver views the recent rebound in oil as significant and says a monthly close above $70 could confirm a bullish breakout. While signaling a shift in the broader commodity landscape, Oliver highlights the Bloomberg Commodity Index's steady base over recent years. He notes that a monthly close above 106.50 would trigger an annual momentum breakout. This, he believes, marks the onset of a sector-wide commodity boom. Commodities historically outperform during inflationary periods, and geopolitical crises often amplify demand for safe havens like gold and energy hedges. The challenge lies in avoiding concentrated bets such as pure oil plays that could amplify losses if supply disruptions ease. While discussing mining, Oliver highlights that gold miners have long underpriced their earnings power but are now beginning to reflect their true value. He expects miners to outperform gold, potentially doubling or tripling its returns in the years ahead. The market is focused on gold miners' ability to meet their targets, particularly around production costs. Consistently meeting or beating production and costs targets should continue to improve investor sentiment toward gold mining stocks and support a re-rating of the sector, lifting valuation metrics to levels more in line with historical multiples. Before we dive into MichaelOliver's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
No, energy is a factor, and frankly, we think there's a commodity boom coming now. And it's not just oil coming up from the hole. The oil got bashed down real hard in that April stock market drop,
Yeah.
whereas the Bloomberg did not go down and make new lows. Most commodities did not. Only oil pierced through its pricing. If you could throw up a oil chart there, we could look at that. Now, you see back in 2008, we got the 140, 50. Then in the 2022 run up, we got the 130. Okay.
Yeah.
Now, that peak was like a month after the war in Ukraine started. Okay, so the
Yeah.
people,
Okay.
it went up because of the Ukraine thing. No, it didn't. It was already up there.
Okay.
90% of the move had already occurred, and you topped shortly after that war commenced. Okay, in February, late February 2022. Then oil collapsed, just like the Bloomberg. It pulled back sharply, and you spent like a year or two sideways there with repeated lows in the mid 60s.
Yeah.
65, 65, 65, 65. You blew through it in April. That's a price chart breakout. Okay, remember that gold chart we looked at a while ago where I showed the breakout in 2022 where you blew through a floor?
Yeah.
Okay.
Yeah. Yeah.
We said that when this oil breaks through that floor, we said this is a bear trap. It's not likely to hold. It's false breakout because momentum wasn't agreeing with it.
Yeah.
And sure enough, we've aborted back up. Yes, it's news related and so forth. But you close out this month, but I'm particularly looking at next quarter, which is a couple weeks away. You close out any month next quarter. So in other words, let some of this news dissipate or get foggy. And you close a month out much above 70. We're well above there now.
Yeah.
You can break quarterly momentum out. You can't see it here. The price chart looks like you've got descending highs. And you're approaching that trend line across recent highs. So even price is now approaching a trend line, a downtrend going back to 23. But momentum is already breaking through stuff that says you're starting a whole new up leg. The Bloomberg Commodity Index in particular we're focused on because it's a broader view of reality than just the oil market. And I think it's about to go up. Now, there you go. In fact, it's at levels you can't close the month out above 106.50 something, because if you do, you're breaking out annual momentum of Bloomberg.
Hmm.
Got a basing process here for a couple of years.
Yeah.
Just nothing. It's a non-event.
Yeah.
And if you close over 106.50 and change, we're going to break annual momentum out and says, I'm going again. Another leg. It won't just be oil.
Okay.
Now, the question about the miners and oil. Yes, oil is a cost factor. in mining production, but it's still low compared to highs we've seen over the last 5, 10 years. And two, first off, this thing with Iran is not that big of a deal anyway. Iran only produces like 1 point something percent of the world oil supply. Okay, so it's not that big of a deal. It's not like Russia, or, et cetera, or the U.S. production. So it is a cost factor, no doubt. But also, have the miners ever really priced in the per ounce profit they're making on gold? No, they're just waking up to that reality. An investment public, which is getting more shaky about the stock market, and asset managers who've got their heads screwed on right, are looking at places to be within the stock market that are not performing in an uncertain way. And I think gold miners have slapped them in the face recently, because gold miners have suddenly grown a backbone, which we expected. Yes, I think miners are a better place to be than gold. I think they could double or triple the performance in gold over the next year or two, which whatever gold does, triple that on a percent basis for miners. Yeah. There's technical reasons for that. And I think silver could outpace them both big time on a percentage basis. In fact, I think this move in silver right now, you paused here at 37, which of course has taken out a bunch of highs. Yeah, you can see the distribution highs up there at 35, 35, 35.
Yeah.
You don't ultimately top that way. You might pause there, but you don't top. You generally spike when you make a major high. You go back to the 2011 high. It was gaseous.
Right,
you didn't. Once you made that high, you collapsed. You never get back to the high again.
Yeah.
I mean, you collapsed the first few months off the high, came back, but you could never get back to the high.
Yeah.
And it was gaseous. It was hardly even a high. The reality up there above the mid 45 level or something, it was temporary. This time we've just come out of congestion, and you'll notice if you draw a line through the lows in 2011 and 12, where silver pulled back to about 25 there, going up, the lows that occurred, right there.
Oh, right. These ones right here?
Yeah, right there.
Okay.
Find the low close in there. Go up a little bit further. The low monthly close in that zone. You'll see a bar there. You go up a little bit further. Take that line up, your line up. The red line's there. Right up a little bit. Take it up. Yeah.
This one?
Yeah, and if you'll look over to the left, you'll see another close at about 27 something. Yeah, and then even back and further, there's a bunch of closes there. Now, if you go horizontally, look at the recent action. Look where that line intersects. We stopped basically at that upper 20s repeatedly there in the 2021, et cetera. Finally broke through it. So you broke through a price level even that said, hey, man, wake up. You just went through a major pivotal zone. And again, we're not behaving like a blow-off top. We're just emerging from congestion.
Yeah.
Our assumption is over the next, say, 5 months or so, next 2 quarters, you're going to see silver in the 60s to 70s.
Oh, wow.
In this surge.
Yeah.
Now, that's not the top. I'm not arguing that's a top. I'm arguing in this particular surge that is just beginning.
In the interview, MichaelOliver explains that central banks will respond to financial stress by printing money and cutting rates, degrading currency value. He points to risks in bonds and an inflated stock market as triggers for central bank panic. Historically, gold rises during such turmoil as it moves opposite to weakening assets. Marking a potential turning point, Oliver warns the dollar is nearing a key breakdown level below 98.35, which could trigger a drop into the 70s. He notes that while the dollar index shows stagnation, gold has quadrupled, reflecting real monetary debasement. The US dollar faces mounting pressure as structural economic shifts and geopolitical recalibrations reshape global markets. Based on historical parallels, Goldman Sachs projects a 25 to 30% dollar decline, while the IMF forecasts a sharp US growth slowdown for 2025. Concurrently, gold prices surged to a record $3,500, with institutional analysts like J.P. Morgan and Frank Holmes predicting further gains to $4,000 to $6,000 amid monetary expansion and trade policy shifts. Gold typically holds up against weakness in the dollar. The dollar's value is off roughly 9% this year, and it lost about 4.5% in the wake of the Liberation Day tariff announcements. Let's get back to the interview.
It's not that they're buyers so much as that they're going to be printers. We know that every time there's a hiccup and gut pain, they come in and they print, they expand the money supply, they lower interest rates beyond reality, and they create monetary stimulus and therefore further sharp degradation in the money unit you use to measure your assets. So the gold price will continue to move inversely to the degradation in the money units. And we see these other factors we've been talking about, like a bond market in jeopardy, government bonds in particular, not mortgages this time, uh, and the stock market bubble, especially here, as being factors that will spark a central bank into panic mode. Now, remember, even if Powell tries to stay tough, and he's going to find it very tough to stay the way he is between now and when he leaves in January, because a lot of shit's going to happen between now and then. That's going to force his hand. Otherwise, the public will be marching outside the Federal Reserve building. So, gold knows that. Gold knows what central banks do, and that's why it lives. So if we have another downside in these other assets that your guest, your subscriber mentioned, that will further impact the central bank into doing exactly what benefits gold, namely degrade the money unit rapidly. So that's why if you go back and look at the 70s or look at these bear markets that occurred in the stock market, gold went up during those times. There's like a few exceptions of a month here and there where it went down with the stocks. But generally, it goes opposite to the stock market in bear trends. Why? Because the central bank is going berserk during that time. This time, even more so. We'll have to. So I think gold knows that. So I think the drop in those categories is bullish for gold. First of all, we look at the dollar index as a separate, it's a major category. It's a big mover, okay, because it's also the euro and the yen. The other side of that is 70% of the dollar index. Yeah, punch that guy up there. That's the dollar index. You can see it's been in a layered decline for decades.
Yeah.
Big drops, big rallies, big drop, big two waves down, two big waves down since 1983, and boom and a boom. Okay. And lower highs and lower lows. So, okay. Now, even the price has nipped out the last few years' lows. If you can focus more on that there, just the last,
last few
you can
years.
see we made lows, and after the high at 115, we collapsed down to 100 level in 23 and 24, and we kept getting buyers there. 100 level, rally, 100. It was really a non-event. In other words, you were in like a 7% range for a couple of years there. Across that. They played a price game. They tried to break out upside late last year, early this year. We said it's a bull trap. Don't trust the breakout. Sure enough, in March, which is in the middle of that range there, you'll find it 104 close in March, which dollar index is going down now. Major trend. Now, even price has followed through since then and broken through the price lows at 100. You had a rally back to 101 after reaching 98 a few months ago, went back to 101. Now you're back down. You even got into the, below 98 in this month. Okay. But you're below that broken structure, groping. Now, there is another level at 98.35. That's a 10-year moving average of the dollar index cash. It happens to be a momentum trend structure that goes back decades. When you plot an oscillator of the dollar index versus its 10-year average, you'll see there's like a multi-point uptrend that we will crack and close below if you close at 98.35 any month this year. We've traded below there. Right now, we're slightly above it. End of the month. You do that, and our last floorboard comes out. And at that point, I would say the dollar is probably headed back down into the 70s. Okay, now, the question is, what does that impact the gold? Well, right now, at the current price, if you get that 98 level, you go back over to the left in 2015, where you go there, that big surge.
Yeah.
We forecasted that bull trend would get bullish in 2012, and it got up to 100. We thought it would get to 100. It did. Went ultimately higher. But in December of 2015, when gold bottomed, the dollar was where it is right now. Draw a line straight across. Effectively, you're nowhere. 10 years, it's gone nowhere. Okay. Yet gold is quadrupled. Okay. So the people that think, well, the dollar has to impact gold. Well, sometimes not. It's the ongoing overall degradation in money units, not just the dollar. And its real value degradation could be different than the dollar index. The dollar index merely measures it versus other degrading currencies.
Yeah.
It doesn't measure the dollar versus its own money growth. Okay. But anyway, so net price to net price, I don't know that there's a great correlation. However, if you get a dynamic down move going in the dollar, that will no doubt help gold. it will be further wind at its back. It's not a pivotal thing. Again, gold is quadrupled, dollar's gone sideways. Okay. But I think a further drop here will exacerbate the situation, will also create wave effects in other markets when the dollar breaks. For example, foreign investors who own what? A lot of American stocks, more so than in history, foreign investors have come into our market. And two, foreign owners of U.S. government treasury bonds.
Yeah, the bonds.
They're affected by dollar movement too. U.S. investors like to forget the fact that the real money unit is degrading, but when they get out of their dollar-held asset and put it back in yen or back in euros, they've had another shin kick. Not just the decline in the U.S. stock market, but the decline in the dollar. So it's a wave impactor, and I think it's about to become active.
After years of relative neglect, institutional investors are rediscovering gold's portfolio benefits. This shift in sentiment is particularly noteworthy given the continued retail investor apathy toward the sector. After years in the shadows, silver may once again be the strategic asset par excellence. Are you positioned for the next phase of the commodity bull market, or will you be watching from the sidelines as silver, gold, and miners make their move? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.